All right, today we're pulling back the curtain on Digital Realty, a company that is quite literally the physical backbone of our digital world. So let's jump right in and see what their latest health check is telling us.
You know, whenever you stream a movie, hop on a video call, or use a cloud app, your data is zipping through a building that looks a lot like this. These are data centers, these massive, incredibly secure warehouses that house all the servers and networking gear that make the internet, well, run.
And guess what? The world's biggest landlord for these digital factories, Digital Realty, just dropped its latest report card for Wall Street. So what do the numbers say? Let's find out.
Okay, so first things first. For anyone who's not familiar, who exactly is Digital Realty?
Think of them like this. They're a special type of real estate company, a REIT, which stands for Real Estate Investment Trust. But instead of owning shopping malls or apartment complexes, they own the actual buildings that power the cloud, social media, and all your favorite tech giants.
And when we talk about their scale, it is just huge. I mean, we're talking over 300 data centers, almost 43 million square feet of space, and they're operating across 6 continents. They are truly the global landlord for the internet's most vital plumbing.
All right, let's get to the main event, the third quarter earnings report. So, how did they actually do?
Right off the bat, the big number is revenue. It grew 10% compared to this time last year. That tells you the business is expanding, and at a really healthy pace. More customers are paying for more of their space and power. Simple as that.
Now, for a company like this, one of the most important numbers is something called FFO, or Funds from Operations. Just think of it as a much better way to see a real estate company's actual cash flow, much better than traditional net income. And would you look at that? Digital Realty just posted a record $1.89 in core FFO per share. The key takeaway here is they're not just getting bigger, they're getting more profitable too.
And check this out. This number really shows you the kind of pricing power they have. When current tenants went to renew their leases, Digital Realty was able to bump up the rent by an average of 8%. That's huge. It just proves how valuable and in demand their space is.
You know, the CEO, Andy Power, he really summed it up perfectly. He highlighted that record profitability and the strong growth and pointed out that it's all backed up by a huge backlog of deals they've already signed, which gives them a really clear runway for future earnings.
So that begs the question, right? Where is all this growth and demand actually coming from? Let's peel back the layers and dig into their leasing activity.
You gotta understand, for a company like Digital Realty, signing new leases is everything. It's the engine that drives the whole train. It's how they fill their buildings and keep that revenue stream growing. Okay, now this is where it gets really interesting when you look at the breakdown. We're seeing strong demand pretty much everywhere. You've got these smaller 0 to 1 megawatt deals, which are often from regular companies, and they're super strong in the Americas and Europe. But then you also have the massive greater than 1 megawatt deals, the kind typically signed by cloud giants, and they're booming too. It's just a really healthy mix of customers.
And this chart here gives you another way to look at it. Of the $162 million in new leases they signed this quarter, you can see it's almost a 50-50 split between those smaller enterprise deals and the giant hyperscale ones. Plus, you've got that solid $20 million from interconnection. That's the super profitable business of connecting customers directly to each other inside their buildings.
Okay, so growth is fantastic. We love to see it. But with any real estate company, you have to ask about the foundation. I'm talking about their debt. What does it look like? Is this growth sustainable?
And here we go. This is the financial health check. Their lenders have a rule. Keep total debt below 60% of your total assets. And look where they are, sitting pretty at 41%. That's way inside the safe zone. This gives them a ton of financial flexibility and proves their growth isn't built on a house of cards.
All right, so we've established the quarter was strong, the balance sheet looks solid, so what does this all mean for the road ahead? Let's look at their own forecast for the rest of the year.
You know, one of the best ways to gauge how confident a company really is to look at what they're telling investors to expect. And right here, Digital Realty is so confident they're actually raising their full-year guidance for that super important profitability metric, core FFO per share. They're basically telling the market, yeah, that great quarter we just had, expect more of that.
And you know, all of this brings us to one final really big question. We are right in the middle of an AI revolution that's creating and crunching more data than we've ever seen before. All of that data has to live somewhere, right? So as this demand just keeps exploding, you have to wonder, what's the actual ceiling for the internet's landlords?